Good day, ladies and gentlemen. Welcome to my YouTube channel. Today, we're going to be looking at exemptions. But before we get into this recording, I just want to say thank you to every single person that has subscribed to my YouTube channel. I appreciate it so much. It shows me that you guys appreciate the content that I produce. To the people that haven't yet subscribed, please show me some love by hitting the subscription button. Thank you guys so much. So let's take a look at the learning outcomes. At the end of this topic related to gross income, you should be able to identify amounts that were included in gross income in terms of the definition that are exempt from normal tax. Secondly, you should be able to apply the qualifying criteria to determine whether an amount is exempt from normal tax or not. Exempt income is income free from normal tax. Income means any amount remaining of gross income of any person for any year of assessment after deducting any amounts exempt from normal tax. Reasons for exemptions. It could be an amount can be exempt due to the nature of the taxpayer or the nature of the income. For example, if you're dealing with a public benefit organization, any amounts that they receive, any income that they make would be exempt due to the nature of the taxpayer. Exemptions from normal tax are provided in Section 10 of the Income Tax Act. I am going to be touching on Section 10, Section 10A, 10B, 10C, 12P, and Section 12T of the Income Tax Act. So this is where the exemptions are in the framework. We've got gross income less exemptions, then that's how you get your income. I am going to be focusing mostly on exemptions due to the nature of the income. And just a little disclaimer, this is a summary, guys. So in a summary, it's impossible to cover every single little thing in detail, but I have tried to include as much as possible. So let's take a look at the war pensions or awards for diseases and disabilities. So if you get a pension, this would be, if you get a war pension, this would be exempt in terms of Section 10(1)(g). If you get a disability pension, it would be exempt in terms of Section 10(1)(ga). And for, occupation injuries or diseases prior to 1 March 1996, this would be exempt in terms of Section 10(1)(gb). And then this compensation, workmen's compensation for people injured in the course of their employment. So the amount paid by the employer would be limited to 300,000 Rand. So meaning that the 300,000 Rand would be exempt, and then the taxpayer would be charged on the excess. Any amounts received from the Road Accident Fund, this would be exempt in terms of Section 10(1)(gb). Yeah. Then there's foreign pensions and compulsory annuities. So if you have been working in another country for a couple of years and you receive a pension, from the social security system, this would be exempt in terms of Section 10(1)(gc). So these amounts go straight into gross income, and then, they are exempt in terms of Section 10(1)(gc), in terms of Section 10. Then there's unemployment insurance funds, UIF benefits. These are exempt in terms of Section 10(1)(mb). So if you come across a question and they tell you that the taxpayer has received a UIF payment, the amount would be exempt in terms of Section 10(1)(mb). Then there's uniforms and uniform allowances in terms of Section 10(1)(na). And this uniform must be a condition of employment. It must be clearly distinguishable from ordinary clothing, and therefore it would qualify for an exemption in terms of section 10(1) NA. So you have to read your question very carefully. For example, if the question says that the taxpayer has received an allowance to buy a pair of jeans, if this pair of jeans is a condition of employment and it is clearly distinguishable from ordinary clothing, then it can qualify for an exemption in terms of section 10(1) NA. But if it's not a condition of employment to wear jeans to work, and it's not clearly, the jeans are not clearly distinguishable from ordinary clothing, then there's no exemption in terms of section 10(1) NA. Then there's relocation benefits, section 10(1) NB. And this is for transfer of employee to a different location. This exemption would cover expenses incurred in transporting the employee, the employee, the members of his household, and their personal goods. So it would cover the transportation costs, the cost of selling the old property and settling into a new property. It would also cover hotel accommodation of up to 183 days. And this must be temporary accommodation whilst the employee is looking for like a permanent residence. Then there's bursaries and scholarships, and these are exempt in terms of section 10(1) Q. The requirements that must be met are as follows. This must be a bona fide scholarship or bursary granted to enable or assist a person to study in a recognized educational or research institution. So if the bursary has been granted to an employee, then the amount is fully exempt in terms of section 10(1) Q. But if the bursary has been granted to a family member of the employee, then there's a partial exemption in terms of section 10(1) Q. So the remuneration proxy for remuneration proxy less than 600,000 Rand equals to or less than 600,000 Rand. So you first have to look at the NQ level of the recipient of the bursary, right? So if the recipient is pursuing a qualification, an NQ level 1 to 4 qualification, then the exemption will be 20,000 Rand per bursary per year. And if the NQF level is level 5 to 10, then the exemption would be 60,000 Rand per bursary per year. There's an additional exemption in terms of section 10(1) Q if the recipient of the bursary or the family member is disabled. So please check it out in section 10(1) Q. Then there's dividends, local South African dividends. These are exempt in terms of section 10(1) K. Local dividends are exempt from normal tax. There are, however, some exceptions. And the exceptions are, if the dividend is paid in the form of an annuity, then there is no exemption. And if the dividend has been received from a real estate investment trust, then there is no exemption there as well. So you have to read your question very carefully. Don't just, quickly exempt an amount without reading the question carefully. Then there's section 10B for foreign dividends. And so for natural persons, deceased and insolvent estates, as well as trusts, that's 25/45 of the dividend that has been received. That's the exemption. And for companies, the exemption would be 8/28 times the amount of the dividend that has been received. Where the taxpayer holds at least 10% of the equity shares and voting rights in the foreign company, then 100% of the foreign dividend will be exempt in the taxpayer's hands. So if the taxpayer holds 2%, of the equity shares in the company, then they qualify for the 25/45, for 25/45 if they are a natural person, and 8/28 if the taxpayer is a company. But if the shareholding is at least 10%, then they qualify for 100% exemption in terms of section 10B of the Income Tax Act. So next up we have interest, local interest. Local interest is exempt in terms of Section 10(1)(I) of the Income Tax Act, and this exemption only applies to individuals because it is based on the age of the taxpayer. So for taxpayers that are over the age of 65, the exemption in terms of Section 10(1)(I) will be 34,500 Rand. And if the taxpayer is under the age of 65, then the exemption will be 23,800 Rand. Local interest received by non-residents, this is exempt in terms of Section 10(1)(H). So if you're a non-resident and you receive local interest or interest from a republic source, you would qualify for a full exemption in terms of Section 10(1)(H). There is, however, an exemption, and there is, however, an exception, and the exception is if the non-resident has been physically present in the Republic for more than 183 days during 12 months preceding the receipt or accrual, then there is no full exemption. Secondly, if the interest arises from a debt effectively connected to the taxpayer's permanent establishment in the Republic, then there's also no full exemption in terms of Section 10(1)(H). So the exemption that they would qualify for would be the partial exemption in terms of Section 10(1)(I), depending on the age of the taxpayer. Then there's tax-free investments in terms of Section 12(T). An investment contribution of up to 36,000 Rand annually per person and a lifetime contribution limitation of 500,000 Rand. So these amounts, these thresholds, the annual threshold changes every year. So just double check if it's still 36,000 Rand this year. But the lifetime contribution limitation is 500,000 Rand, right? So if you invest over 36,000 Rand in a year in a tax-free investment, the 36,000 Rand is exempt, and the excess, you would be penalized on the excess of 36,000 Rand, and the penalty would be a 40%, right? And the lifetime contribution limitation of a tax-free investment is 500,000 Rand. So if you have invested more than 500,000 Rand in your tax-free investment, it means only the 500,000 Rand would be tax-free, and the excess would be subject to a penalty of 40%. Then there's alimony, which is exempt in terms of Section 10(1)(U), and this is for court-ordered payments awarded to a spouse or former spouse after separation or divorce. The reason is to provide for financial support to the spouse who makes a lower income. So if there's a couple that has gone through a separation or a divorce, and the court orders one of the spouses to pay alimony, so that amount would be included in their gross income in terms of a special inclusion, right? And it would be exempt in terms of Section 10(1)(U). Then there's Section 12(P) for government grants. Government grants are exempt from normal tax in terms of Section 12(P) of the Income Tax Act. Then there's purchased annuities, and this is as a result of a contract with an insurer. There's a lump sum payment which is made, and so therefore the capital element of an annuity, of that annuity, would be exempt. So not all annuities would be exempt in this manner. It's only purchased annuities would be which would be exempt in terms of Section 10(A). And so this is how it would be calculated. The capital element would be calculated this way. You'll have Y equals to A over B times C. So Y will represent the sum to be determined, which is the capital element, right? And A would represent the cash consideration given by the purchaser under an annuity. And so A is basically the amount that you are using to purchase that to purchase that annuity. And then B will represent the total expected returns of all annuities provided for. So yeah, so that's what B will represent. And then C will represent the aforesaid annuity amount. So guys, please check it out in section 10A, so that if you come across a purchased annuity in a question, you are able to calculate the capital element of that annuity, which is exempt from normal tax. Then there's employment outside South Africa. There are many other exemptions that I didn't include in this recording, because like I already mentioned, I'm just summarizing the exemptions that will pop up a lot in your questions. But obviously you have to know all of those exemptions. So please check them out in section 10. Then there's employment outside South Africa in terms of section, this is exempt in terms of section 10.1.0, subsection 2, right? So this exemption would be in respect of employees who are South African residents, any remuneration in respect of services rendered by way of employment outside South Africa for or on behalf of an employer who can be situated in or outside the the Republic. So it doesn't really matter where this employer would be situated. What's important is you're a South African resident, you're earning remuneration in respect of services rendered by way of employment outside the Republic. And during a qualifying period of employment outside South Africa of 183 days, plus an additional 60 days. So both of these requirements must be met. You must have spent 183 days outside the Republic, plus an additional 60 days outside the Republic for you to qualify for the section 10.1.0 the section 10.1.0 exemption, right? So yeah. So guys, if you have any questions, please don't hesitate to drop them in the comment section. Let me know if you have a specific question. Yeah. So let's take a look at this example, right? Tom, a 40-year-old police officer, receives a uniform allowance of 800 Rand per month to purchase his uniform to wear to work. We also have Sarah, a 35-year-old taxpayer who earns 600,000 Rand annually and has received a bursary of 95,000 Rand from her employer towards studying for her postgraduate studies. In the event that she's not successful in her studies, she won't need to reimburse that employer. And then C, we have a 45-year-old taxpayer who has earned a local dividend of 65,000 Rand during the year of assessment. So you are required to indicate whether the following transactions will be exempt from normal tax and calculate the exemptions if there's any exemption. So this is my homework for you guys, just to test if you have learned some of these principles that I shared with you guys today. Will the police officer who has received a uniform allowance of 800 Rand per month qualify for an exemption? Will this uniform allowance qualify for an exemption? And number two, Sarah, who earns 600,000 Rand annually and has received a bursary of 95,000 Rand from employer towards studying for her postgraduate studies. Will Sarah qualify for any exemption? And if so, how much will be the exemption? And lastly, we have a 45-year-old taxpayer who earns local dividends of 68,000 Rand during the year of assessment. So let me know in the comment section, guys, what do you guys think? How are we guys going to treat these three different taxpayers? Will they qualify for any exemptions? And if they do, in terms of which section, and how will the exemption be qualified? Thank you guys so much for watching. Please don't forget to comment, like, subscribe. Thank you guys. Enjoy the rest of your day.